When rents and interest rates were more predictable, it was a lot easier to figure out what prices would make great investments. But in the past 6 months, everyone seems to have a different view of where rents and interest rates are going, and that's what's causing much bigger swings in prices from deal to deal. Now, more recently, things are starting to stabilize, which means the range is slowly going to narrow again. So in this video, let's try to figure out where things might settle once they stabilize. But before I continue, if you enjoy content like this, don't forget to give this video a thumbs up and subscribe to our channel so you don't miss other videos like this made specifically for real estate investors in Toronto. The typical Toronto investor isn't looking for huge cash flows. They invest in Toronto because they are looking to build generational wealth, or they might want to provide their kids with a separate home once they grow up, and they generally want to reap the long-term benefits of appreciation. Still, holding power is key, and it might even be more important these days now that we're reminded of how things can get shaken up. And so freeholds are getting more and more popular as investments since they do generate positive cash flows of a few $100s per month to help out just in case. Now, in a normal market where rents and interest rates are more stable, it's easy to work out what purchase price needs to be to give you that couple $100s of positive cash flow. And because of that, it's a lot easier to predict how much homes would sell for. Nowadays, assumptions are all over the place. If an investor is using lower rents from a few months back and they think interest rates will go up by another 1.5%, then the price they're willing to pay would be pretty different compared to someone else using today's rents and today's variable rates. Yes, variable rates are still rising and we might still have 1.5% to go. But inflation is stabilizing and we're probably in for a recession, which is going to slow down rate hikes. And if you look at bond yields, they went up and then back down and haven't actually broke the ceiling from June. Basically, the market is telling us that the amount of future rate hikes have already been priced in and hasn't really changed much. And since 5-year fixed rates are based on 5-year bond yields, we are close to peaking here too, which means that using current 5-year fixed rates for calculations are pretty safe these days. Next, let's talk about rents. You hear about rents rising, but what we're finding is that investors don't actually realize how much rents have risen and how equally as significant they are as interest rates on the selling price. A multiplex that could have been rented out for $4,000 per month a year ago can now be rented for $5,000 today, and this is part of what it takes to soften the landing for investment properties in Toronto. I want to touch on where rents are headed next as well. We are seeing strong demand for rental properties, primarily from new immigrants coming to our city, and that's what's going to keep rents strong. But with inflation looking to peak in the coming months, this is also going to slow down rent growth next year. And so, to be conservative, we would stick with today's rents for our calculations. Now, let's take a look at this example. Based on today's rents, the upper 4-bedroom unit can be rented for $3,400 and the lower 1-bedroom unit can be rented for $1,600. Operating expenses here are around $750, so that takes our operating income to $4,250. If we need $200 of positive cash flow, our mortgage payment will need to be a max of $4,050. With a 20% down payment and a 5-year fixed rate of 5.25%, the likely floor price would be $920,000. Just as a comparison, if someone was using $4,000 of rent instead of $5,000, the floor price gets taken down to $690,000. So accurate market rents do make a huge difference on purchase price. Now, this $920,000 floor price is very specific for properties with an NOI of $4,250. So a better way to figure out whether a property is hitting the average floor price would be to look at the NOI as a percentage of the property price, aka our favorite cap rate metric. The sample property we just talked about has a cap rate of 5.5%, which is probably the average cap rate when the dust settles if you have similar assumptions for interest rates and rents. Obviously, if you have different views, your cap rate would be different, and we are very interested in the why, so feel free to comment below and let us know what cap rate you might be looking for and why. Like I mentioned earlier, selling prices are all over the place right now because assumptions are also all over the place, which means that this is the time where you have the best chance to get deals over a 5.5 cap rate before things are more clear and the range narrows again. And if you want to find out what the best deals look like in Toronto these days, we're happy to chat. We're a real estate sales brokerage that focuses on investing in freeholds in Toronto, and we search the market every day. When you work with us, we take the time to understand your needs, teach you the ropes, and help you buy the best investment property for you. But that's not all. Our team also provides renovations guidance, leasing, and property management if you need it. So just connect with us if you want to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.